Pleasure to be here. Okay, recording in progress. So, who am I? I'm Danny. Clearly going through a midlife crisis with my longer hair, as opposed to the picture. But as a day job, so I used to be deputy chief executive of something called Big Issue Invest, which is social investment arm of the Big Issue magazine, which hopefully you've bought at some point. It's one of the largest social enterprises in the UK, helping provide income for vulnerably housed people. And we realised pretty quickly at the Big Issue that we had one great idea 25 years ago, and we had a brand that could raise a lot of money, but there were lots of people out there that had better ideas to solve social problems than us. So our great idea was we would raise money using a brand and invest it in projects up and down in the UK. And that went quite well. I mean, we ended up investing in something like over 1,000 projects in the 7 or 8 years that I was there. So I kind of managed 7 funds. I moved on from them, and I'm now, I guess, head of all kind of lending under £1 million at Charity Bank, which I do under a kind of part-time basis. And that's my proper day job that pays the bills. I do that 3 days a week. But that's kind of frustrating in some ways, and I'll be honest with you, because it's a national scale, it's larger charities and social enterprises that we invest in. And although there's a lot of social impact, it doesn't really have a local edge. So 2 days a week, I've gone off and tried to do something kind of more local. And what I found at Big Issue in particular was that there started to be clusters of social enterprises and enterprises in local areas. And once you invested in 1 or 2 of them in a particular area, you started to get momentum, and you got a little group of investors and investees together, and they almost provided peer support to each other. So we were the linking point, but once we actually linked them together, they started providing support to each other. And at the end of the program, you kind of realize that, all right, we might have lent them 20 grand, which is a lot of money, and it helped a lot, but actually they got far more out of the relationships that we were able to introduce. And there are often quite a lot of people working in small areas who were doing similar things that just hadn't met each other. And so I thought that the kind of day job of working at a bigger level, you don't really get to kind of focus on that sort of stuff. So that's what I do for the other 2 days a week, is I'm kind of launching smaller programs, not dissimilar to the ones that I think you guys are managing, which are focusing very much on providing micro investments, small grants, with a view eventually to creating similar kind of networks where people start to do stuff themselves. And I can talk a little bit about Eastwick Growth Fund in a second, because it's not too far away from you, but I've set it up, I've managed to track the funding, I'm doing the initial investments, but hopefully in 3 or 4 years' time, there will be an investment committee of local people, hopefully the people that we invested in the first time round, and I'll be able to step away and kind of hand it over to people, and they will have more responsibility for it than I will. Having said that, there's still some parts of running the fund that you need to have someone with professional experience on board. And it's an observation, for example, that I have had plenty of applications from people who may or may not be breaking the law in one way or another. And that actually causes a bit of a conundrum about what you then do. And yeah, you kind of have to have some rules, policies and procedures in place, and be awareness that that sort of thing will come forward. So I think I'm here, not talking about myself, but to talk about pipeline. And I think first thing I would say is it's the most important thing for a fund. It's absolutely critical. So I've just been on a call this morning with something called the Growth Fund, which was £50 million of money that got pushed out by something called Access to launch 16 small funds across England, and almost all of them failed. And the reason they failed was because they didn't put enough focus on pipeline, and they all started behind the curve. So they had a set kind of deployment periods, and they thought they were going to invest that kind of much, and they all started slowly, and it gained its own momentum negatively. So I would suggest that what's really important is if you've got resource or effort, that almost all of your resource and effort should be going into pipeline development, because without good deals, you don't have a fund and you have nothing to talk about. And as soon as you make good investments, you've got something to brag about. and something to kind of highlight, and it brings people in, it gets them excited, it gets them to understand the sort of thing that you want to do. So I would say that focus your attention on pipeline, make sure that before you launch, you've got exactly the sort of investments that you want ready to go. So if you guys are launching a fund 6 months' time, 9 months' time, the pushback I would say to you now is show me the ones that you're going to launch with. Show me the investments, the types of organizations that you want to invest in. And if you haven't gotten them, you need to find them. And you need to find them before you formally launch, because they are the best form of advertising that you're going to have. And I've found personally that there's many different ways and networks of finding people, but word of mouth and referral of people who have already borrowed money or taken money from you is the most important thing. And I should say as well that I'm not a grant maker, so I'm an investor. We all the funds that I work on, we invest and we want the money back. We're not necessarily too bothered about the returns, to be honest with you, but it's a very different thing from being a grant maker than being an investor. And I'll come to that again in a second. So first observation is pipeline is everything. Put as much resource as you can into it. And second one is, if you are going to launch the fund, have some really good examples that are ready to go before you make a big song and dance about it, because otherwise it will slightly fall flat on its face. And then I guess the third thing is there are really only two ways. It's a bit extreme. Two ways of going down it in terms of marketing and developing pipeline. And one is what we do at Charity Bank, which is a wide approach. So you kind of throw the kitchen sink at it. You do glossy marketing, you go through your website, you get your search engine up and running, and so that when anyone types in, I'm after money embarking, you come up number one. You rely heavily on the kind of professional networks and brokers, the professionals out there that are providing support, accountancy firms, or even business support agencies. We go to conferences, we're very visible, and actually we pay for referrals. That's another important thing. It's a good way of driving business towards you. However, that is highly inefficient, and 99% of the stuff that you get is crap. And I mean that in so you've got to be careful. The Charity Bank has a lot of staff, and the deals that it's dealing with are big ticket things. So it can afford to take 99% of the applications and move them to one side and say, but even saying no to people takes up a lot of time. And it's also highly inefficient in terms of getting what you want. So I can tell you at the moment, the Charity Bank's mission is very broad, so it'll happily invest in any charity. This last month, we've mainly been investing in churches, which is really nice. I like investing in churches, but it's almost exclusively churches. And I think if you sat the Charity Bank board down and said, what do you want to do this month? It probably wouldn't have been churches. It would have been a nice broad spectrum of different social kind of impact stuff. So the problem with the wide thing is that you don't really control what you get. It doesn't really necessarily hit all the impact that you might want to. So I don't know what your objectives are, but it's much harder to control that. And also it's highly resource intensive. For not very much reward. You kind of want to be looking at as fewer applications as you can. So almost if you can get one application in to get one actual investment in, that would be the perfect scenario. What a lot of social investors and funds do is they have a very wide funnel. And I suppose the dynamic you're going to have to work out is you're a democratic fund. So you really kind of want to be going out wide, to be fair. I guess my message to you is you don't have to do that straight away. And you probably want to go down the second approach, which is being narrow and building that up over time. So that's the second approach, which is probably one that we're doing at Eastwick, and I'll come to that in a second. Is narrow approach is you try and be as targeted as you possibly can. And that, I guess, reflects specifically what your objectives might be. So if you've got very clear objectives, and you've got not much resource, that tells you shouldn't be approaching many people. You should be approaching a very, very finite group, and also perhaps one or two organizations, and try them out, work out what's successful and what's not. And if you can combine that with having some good investments that are ready to go with a very narrow focus, it gives you time to kind of, you know, try things out almost in like. So how does that apply to, oh, actually, just on that point as well. So if you're going down that approach, and it is an interesting one, is you have to realize that most applications for funding are not fully formed and they need a lot of work. And so I think you know, if I looked at 2,000 applications, there'll be 2 for funding that I look at and go, oh yeah, they can get the money. Great, that took me 10 minutes, brilliant. Generally speaking, you're not leaving, or you shouldn't just be leaving an application process to itself. I'm just expecting people to have all the information that you need and to be in a good place to take on money. That might be appropriate for large organizations who apply for money, but for smaller ones and smaller charities and social enterprises and small SMEs, you really need to walk them through the process. And that isn't about due diligence. It isn't about you know, being mean and setting up barriers. It's quite the opposite, actually. It's about trying to make sure that they are in the best possible place they can be to take your money and succeed with it. And I find that generally means getting them to do a cash flow, and you actually have to sit down with them and walk through it and say, all right, you want to set up a market stall that sells, you know, shoes. All right, how many shoes are you going to sell a day? Multiply by the price, and you go in really, really granular detail. And that's quite labor intensive. But actually, what it does mean is that the people that you do have touch points with, you've got much more success rate of actually investing in them because you've built a relationship with them further down the line. So Eastwick Growth Fund, which is the thing I launched last year, is doing a combination of all 3 of these things. So it's a micro fund. We've got about £1 million to invest in organisations and people around the Olympic Park. So that's the four East London boroughs of Newham, Tower Hamlets, Waltham Forest and Hackney. And I've deployed a combination of all of those tactics one by one. So first round, you think of the investments as in 4 rounds. First round, as it happens, most of my networks are in charities and social enterprises. A lot of them work in East London. And I basically went to them 9 months before launch and said, we're launching a fund. I know that you guys are doing good work. I also know that you need money. This is a fund that's going to be good for your area, and our values are aligned. Have you got a project that needs funding? And when we launched, 50% of the fund could be allocated to these high quality social impact driven organizations that were kind of the type of ventures that people could feel good about, stories that you could tell to people and they get excited about it. And to be clear, first round, my funder wanted me to do a massive splash in all the local press, wanted me to go out on, you know, as widely as possible. But given I was working 1 day a week at that point on the fund, that would just be impossible. And it'd end up just, you know, the wheels would fall off the bus somewhat. So first round was to kind of have some surefire things that I'd been talking to people for 9 months beforehand that I could launch with some good investments. The second round of investments came from the funder. So the funder is a development partner in the Olympic Park, and they have lots of tenants, and their tenants have lots of tenants. So after we made those initial investments into high quality social enterprises, it was to go to their SMEs who were tenants of their buildings. And that actually gave me a ready market where I could just walk around the properties, knock on the door, very physical, you know, very kind of face to face, very hello, very kind of like, actually, you might not have anything just now, but this thing is here if you want it. And it was, you know, almost boots on the ground, walking around. And I could do that because we already had some good investments behind us. And that actually led to our second round of investment. So Gerard, it's called the Eastwick Growth Fund. And they've been a really interesting group of, they're mostly sole trader businesses, some of them doing stuff around you know, eco delivery, some of them are are plumbers, some of them are chippies, some of them are doing digital stuff. It's a complete range. What they all are small businesses that started out maybe 12 months ago and are now starting to grow and employ local people. And I really like that. So that's where our second group of investees came from. The third one, the fund's got a target not only of getting the money out the door, but also trying to help minoritized groups or individuals who are unlikely to be able to raise money anywhere else. And that includes younger people, it includes, mothers coming back into the employment market, includes people who are just trying to start little businesses and selling things here and there, not necessarily in a way that, certainly not in a way that would be able to go to a mainstream bank and get money. And the observation there is that those are the guys that really need hand-holding. And they're probably, they've applied for a bit of money and come through various networks, but they're not ready to take on repayable debt. There's a thing called the Reach Fund, which I think you guys should definitely get involved in. They provide small amounts of grant funding to provide professional support to help people get ready to take on investment. You can say it as taking investment, but actually what you're saying is people get their business plan together in a way that makes sense. And I think we've probably made about 15 actual investments, but we've taken about 12 people through the Reach Fund. And I can say almost all of them are women, and almost all of them are BAME, and almost all of them have a really good business idea that's not quite ready to take on investment. But with that grant support, they will be ready in 12 to 18 months' time. And that's where my pipeline is coming in 12 to 18 months' time. And then lastly, the fourth round is all those people that we invested in the first round and the second round have told their mates, and their mates are now coming over and asking for money. And we're now going to get into this slightly virtuous circle. And so it's slightly counterintuitive in the sense that you feel like, as a fund, you should go as wide as possible. And I think that's, and get into newspapers, have as much volume and noise about it as possible. And that does work for some people. Personally, I find that just means that you get too many applications which you cannot spend enough time on. And as I said, you can pick one or two relationships very, very closely that align with what you want to do. And I would focus on them. And as long as you've got the ones at the start that are good investments, it buys you time to take your time for the rest of them, I think. So that was a ramble. That was a data dump. I've probably given you too much or not enough. But yeah, if you've got questions or anything that I didn't actually make clear, which is probably all of it.
Thanks, Danny. I was just going to say, Joe, you're very welcome to chair this if you like. We were planning to chair this bit of question, but you don't mind.
Happy to either way.
Cool.
Yeah, who wants? I mean, I might have a couple of questions
Sure.
myself, but I wanted to ask anyone else wants to go first.
I have a question. You said, Danny, that sometimes you don't worry about the returns. Why is that so? Why don't you worry about the returns when you're investing?
Because if I genuinely think so, there's a starting point here, which is that small businesses and social enterprises at a certain scale, you're going to lose money, right? And it's even there's a reason why mainstream banks do not want to lend small amounts of money to anybody. You can be very, very, and a most amazing business plan ever, and you can go to Barclays Bank and ask for 10 grand, and they'll tell you no, right? Unless the director's kind of guarantee. And the reason they don't want to do it is twofold. One, it costs them too much to process, and the second is that they lose money. Historically, lending to SMEs they go wrong. And so if your starting point is that you're going to make an awful lot of money, it leads you to invest in a very narrow range of things. And that might be, for example, property or things that you end up having to be evidence-based, and you only invest in things that have worked before. And, you know, as an investor, that's great. But I guess if you have a fund, like Eastwick Growth Funds, its objectives are not necessarily to make anyone rich. Their objectives are to make things happen. And there might be, you know, in another world, there might be a follow-on fund from the Eastwick Growth Fund, which is taking more commercial point of view. But the Eastwick's Growth Fund is hoping to make things happen and get its capital back. And I've sourced another way to pay for the costs of actually making it happen. And that's because I recognise in the 20 years that I've been working in social investment, there has to be some subsidy somewhere. And you have to accept that working at this level that you are going to lose money on your investment one way or another. And your only way around that is by charging a significantly higher interest rate than most people will bear. So I'll give you an example. Charity Bank, it charges at the moment 4.5% on property. 70% loan to value. The bank cannot lose. You know, it's rigged. So those deals, even if they go wrong, there's a property from the sale, and they're still charging 4.5%. So if you go to the spectrum of something where there isn't a property, and it's proper, genuine working capital, cash flow, and there's maybe one or two directors, anything could happen. You know, I could be running a fund. I could fall in love with someone from Scotland and go back home and just drop down tools and leave the debt behind. You know, you're dealing with people, so that's why I don't focus quite so much on the interest rate, because I think it's very difficult to gauge. And secondly, and I should have said this at the start, is that I sound like I know what I'm talking about. I have that habit of doing it. But Eastwick Growth Fund is a bit of a learning exercise for me, and I'm learning as I'm going along. I've been used to doing slightly larger investments over a much, you know, a greater geography. Eastwick Fund, I'm putting into practice things that I think will work, but I haven't done it before. So I'm learning as I'm going along. And thankfully, I've been able to develop a strategy almost by accident about how to get pipeline. Really, if you ask me, do I genuinely understand the pricing? No, I don't have enough data at this point. And I'm charging somewhere between, I think it's 2 and 6%. And that's because I want to make things happen. I don't want people to be put off by an interest rate. And people will be put off by high interest rates. I guess in 3 or 4 years' time, once it's been through a couple of iterations, I'll actually be able to tell you, oh, actually, I was wrong. You know, I should have been interested in the returns. And I think this is the amount it could bear. At this point, I don't have the evidence to say that categorically to people I can deliver X, because I don't know yet. Don't know. And I think I would be careful about A, fixating on a return, and B, telling people that you can deliver a return. I'm a director of something called East London, well, it's now London Citizens Community Land Trust. And we did a share raise to help build affordable homes. Hand on heart, we thought we were going to take the money from the shareholders, build homes, and give people a return of 5%. And we did all the modelling. It looked like a very sure thing. Of course, if you get involved in property, planning happens, the GLA takes 2 years to get something approved, and the time frame just goes on. And without, you know, us doing anything wrong, that return went from 5%, and it's probably a bit less now. But it was just, you know, the expectation of our investors is that they'll get a 5% return, and it's difficult to then go back and reset their expectations, particularly if you want to go back with them for a bit more money as well. So I just think it's, I think one day I will be focused on the return, but I think that pushes you towards certain types of enterprises and doesn't let you experiment and take risk. And perhaps, I don't know what your fund objectives are, but for mine it was to back people who no one else wants to back, or try and innovate and do stuff that's different, create jobs. Sometimes that goes wrong.
There's another question in the chat, but just before we go to that one, perhaps as a follow-up here. So what if you're not focusing on return, you're still expecting to get your money back?
Yeah.
So how do you put your expectations there? And what's your kind of success rate? What's the kind of that kind of depends of how well you've done your selection, I suppose, before.
Yeah.
But yeah, all of that. And then do you lend to charities as well as social enterprise? Sorry, it's a jumble of questions there.
Yeah, we'll lend to anyone apart from individuals. You might want to watch out to lend to individuals, you've got to have a credit consumer license, and that's not easy to get. So we'll lend to anyone that's got a kind of corporate structure. Love lending to charities, their favorite. And basically mainly it's mainly limited companies at this point in time. We've only been investing for, it was April last year. So I can say we've got 100% success rate of no one defaulted at this point in time, but it will not stay like that. And the interest rate that we charge at this point in time, I should say that part of the funding is investment I have to give back, but part of it is a grant. So I have the luxury of not having to give a return to all my investors, and also they will carry the bulk of any bad debt, which makes it a lot easier. And I can tell you, in terms of taking risk, that also makes things a lot easier. So there is an interest rate that's being charged, and ultimately in the longer term, that's there to help try and bring in further investment down the line. But it's also to help cover any bad debt that might happen. So no bad debt at the moment, and because I've tried to keep it personal and local, people want to pay us back, and people do buy into the vision of that. And as I said, they become the best referral, for pipeline. But there will be some bad debt along the way. Some of these ventures will go wrong. And I guess I'm not doing my job properly if some of these things, if we don't invest in something that fails, because then it's just all safe bets, isn't it? And I'm not quite sure where you're going with this in terms of investing, but if you do have a pot of funding that you are committed to giving the investees returns back, then you probably do have to think about, is there another fund or another mechanism you have to raise money to take the risks that you want? And as I said, investing in small businesses and charities is a very risky thing. And there's the macroeconomics of it all as well, that suddenly something happens, interest rates and inflation go up, suddenly all sorts of businesses just start to shut, and it tends to all, everything goes well and well, and there isn't much going wrong, and then suddenly if the economy changes, it all kind of goes wrong at the same time.
Yeah. So I've read that figure somewhere that 50% of SMEs go bust in the first 5 years, something like this. Yeah.
But that's also kind of misleading, because it's not a question of going bust. People get married, they move house, they move country.
Yeah.
There's any different reasons why they give up, and also
Sure.
sometimes it's just hard work. So
there's a couple of questions in the chat. So one is from Kazang. What is your thoughts on the Princess Trust?
I think they're really good, and would be a good, depending on your what you want to do, great source of pipeline, great source of people. They provide a lot of support and guidance to people in advance. I haven't partnered with them personally, and that's because it tends to be individuals that are coming out, entrepreneurs rather than companies. But I would definitely be going. I would definitely go to speak to them. I think they're a great organisation.
Great. And then a question from Emma, which I had the same question. You mentioned that the majority of applicants will need support or hand-holding, and that's quite labor intensive. So who gives that support? Is it the staff team of the fund or experienced business people? It's probably funded or someone else.
Staff team of the fund, come on now. If you do the numbers in your head, it's £1 million fund charging 3%. that's 30 grand a year if you're lucky. So it's a combination of me, but actually what I've been able to do is source small grants which get professional advisors in. However, what I'm really proud of is there have been a couple of grants where some of the first investees are now being paid to provide support to some people coming into the fund. And actually, I think they are better placed to give that kind of, well, quite often professional advisors are like me, you know, they've worked for a bank. They haven't run like a small business. So they're not necessarily either, I don't know, they haven't had to worry about the cash of a business in the same way that the people coming into the fund have. And sometimes also there's a bad cultural fit as well. So the dream is that, and particularly with that third strand of people I was talking about, which is the people who are receiving grant support now, is to create this network of people who've been through getting advice, have actually taken on investment, have set up businesses, and maybe we can start paying them to give advice to each other. And they're better placed than me to support them. I do some of it just now, but it's really about trying to build up that network. And I would also say that we mentioned the Prince's Trust, which is great. And there are a number of kind of anchor organisations in the area. So, for example, Bootstrap in Hackney, it's two big old buildings. And if you went in there, they've got you know, a number of rooms where small businesses are kind of being incubated. They've got hot desk space, that sort of thing. They're the sort of, you know, I don't know if there's an equivalent in Barking-Dagenham. I'm sure there's a business centre, but they're the sort of people that I would be going to speak to first of all and saying, where would you find people? And you probably find that the people they would recommend are sat on the first floor and the second floor. And if you ask people nicely, they do tend to pre-screen. So they tend to pass on people who they think are good. Now that's good from a financial point of view. It's terrible from an exclusion point of view, because people tend to refer in quite a narrow range. So as long as you're aware that you're getting better quality applicants, but it's also excluding people, and you need to do something about, you know, balancing that up somewhere along the line.
Wonderful. That's really, I'm very aware that we're coming to the place where I promised you all a break, but it's really interesting as well. So I'm just trying to get that right. Is everybody about ready for a break for a few minutes?
Yeah, that's a few head nods.
That is a few head nods. I know we've got people who were very, very excited about today, but were very, very tired as well at the beginning. So I don't want to make everyone exhausted, but I just want to say a massive thank you.
Just before, Daniel, are you staying to the break or not?
If you want, and just say, I mean, I had a quick look online. What you're trying to do sounds great. There's an open invite to ask me, you know, I'll come and say hello if you want. Ask any questions. And I know I've said a lot of things, and people have a habit of making things sound harder than they are. They're not. Once you start, you'll find your own way. I'm learning. You guys will learn too, and I'm sure it'll be a great success. But you know, if there's any other time you want me, you know, want to run past something past me, or even tap into some of my networks, I'd be delighted to help.
Brilliant.
Thank you, Sarah.
Thank you. I'm going to put up a couple of questions that we're going to be talking about after the break. So I'll put that up. And also, if you want to stay on and talk to each other, please do. But if you can have a look at those questions.